Hey everybody, this is Justin Bogard with Bright Path Notes, and this is the Real Estate Note Investing Be the Bank Meetup for October 14th. Let's see, I've been doing this for about 3 years now, and we typically have a live version of this in a facility where I go to called Launch Fishers, and we'll explain more about that later. And we've been doing most of our stuff via Zoom now, our meetups. I think since March, we've done every month since March, we've done a Zoom meeting. I think in July, we did a Zoom and we did a live version as well. So we did that streaming. So once we get back to live versions, in person, we'll still stream them on Zoom. So you can still be a part of that as well in the future, because we feel like we have a lot bigger audience now that are wanting to connect with us, outside the state of Indiana, because I'm mainly from Indianapolis area. So like I said, we are recording this tonight, so the replay will be available probably tomorrow. And you can get that through our Facebook page. That's Real Estate Note Investing Be the Bank Meetup. And it's a Facebook group page, sorry, I'll clarify that. And we also have a Bright Path Notes Facebook business page. So be a part of that. If you want to get on our newsletter, just sign up at brightpathnotes.com and you can get on our newsletters. On the very first page, you can fill out your info, first name, last name, email. You are on the list and you'll know about future meetups, future events, deals we have for sale, and things like that. So little housekeeping rules here. So if you are new to Zoom, which most of you probably aren't, we're probably all pretty familiar with Zoom or something like Zoom. There is a Q&A button in your kind of Zoom little bar. I think on your guys' screen, it's at the bottom. So you can ask a question on that, and I'll get to it to a certain point in the meeting and answer it for you live. I do have the ability to unmute you if you want to talk as opposed to write it all out. Sometimes it's better to have a back and forth conversation. That's perfectly fine. We also have a chat box available that you can talk directly to me through there as well. And I'll try to monitor that as well. But if you have a true question, definitely use the Q&A. That way I can keep track of it that way. Otherwise, I'll try to watch and monitor the chat box as well so that we can answer your questions for you. I did have Tiffany email me something earlier today. So Tiffany, you can put that in the Q&A if you find it. Other than that, I did print out your email, so I should be able to get to that later today. Moving forward, here I am. Real Estate Note Investing Be the Bank. There's my name, my email, justin@brightpathnotes.com. You can check out the brightpathnotes.com. We have a Facebook page like we talked about. We have Twitter. We have Instagram. We have a Vimeo account, which is like a video account, kind of like YouTube. We also have a YouTube channel as well, where we post a lot of stuff. The Vimeo account, more of pre-recorded animations that we've done. I have a LinkedIn account as well. Connect with me on LinkedIn. I'd be happy to connect with you. Big disclaimer here. I'm not an attorney. I'm not a tax consultant. I'm not a financial advisor, so I won't be able to help you out in those categories. I do get asked a lot of technical questions about taxes and things like that, so all I can do is give you my experience and my thoughts on it, but please go to a professional to get those questions answered. I can just, like I said, I just give you my experiences. So this meetup wouldn't be possible without some sponsorship. So we do have sponsors for our meetup. My company, Bright Path Notes, we've got the deal flow to make your cash flow is our slogan, and that's what we provide to the meetup. This meetup does take a lot of time and energy to run and host and manage and stuff, which we love to do, but we need some help doing that. For a real estate education part of the meetup, it is CIREA. CIREA stands for Central Indiana Real Estate Investors Association. Vicki Perry is the executive director. It's an organization that I'm a part of, and I'm a vendor as well. It's for local Indianapolis, kind of central Indiana, obviously, for the name Central Indiana. And so they provide a lot of great education for people starting up just in real estate in general. It doesn't have to be about notes. It can be about wholesaling, fix and flipping, landlording, the BRRRR method. I mean, a lot of cool things that they do, and they provide a lot of great content for you. Like I mentioned before the recording, I work at a place called Launch Fishers. It's like a big shared workspace when I'm not working from home. And Libby Hales is a contact there, libby@launchfishers.com. If you're in the Indianapolis area, you're familiar with Fishers, Indiana. And so that's where this facility is at. It's a big, giant building. You got tons of communal space there. You can just roll up there. You can set up your laptop. You can work there all day. I think they charge me around $1,000 for the year to have access to it. They have fast internet. They have private phone rooms. They have meeting rooms that you can schedule and reserve for no cost to you. They do have a big theater room, and that's where we actually host our meeting when it's in person. And so when we get back to that, you guys will be a part of that, those of you that are local. And our last sponsor is our due diligence sponsor, which is Baldwin Advisory Group, or BAG for short. Dickey Baldwin is a vendor we use pretty much exclusively for a lot of our exterior property inspections, our BPOs, and our title searches. So Dickey's a great guy. He's been in the business a very long time, and he does other services besides title searches, BPOs, and property inspections. He does skip tracing. He does, I think he's got other vendors that are tied to him as well that he has an extension. So it really is one bag for all of your tricks. So Dickey's a really good guy. There's his phone number, his email, dbaldwin@baldwinadvisorygroup.com, 936-447-4170. Just a little bit deeper into Cyrea, because they are a huge sponsor for us and a great resource. Some of you may be members that are on this call right now and have gotten this information about this meetup because of Cyrea. Don't forget, they have a following on Facebook, which is @Indiana Cyrea. They have a LinkedIn page. You guys can see that there. And they also have an Instagram page. I probably should have told them they should truncate their handles a little bit shorter. But anyway, they post all of their educational stuff on YouTube. YouTube's obviously free channel. And you can see a lot of their content there. So you can see some of the vendors like myself and other people a part of the group. And it's just a great organization to be a part of. Even if you're not in the state of Indiana, you can still reach a lot of people through being a part of that group. So you do get PHP credits for Cyrea, being a Cyrea member. So if you log into your smartphone, or if you have a second monitor, you can go to a webpage and type in www.bit.ly/Cyrea notes. And you'll get your PHP credits for that. I always forget what the PHP credits stand for. I think it has to do with housing partnership. It has some sort of validity maybe in the future, that if you have enough PHP credits, it gives you some sort of clout, I guess. So that is that spiel there. For those of you who don't know, I'm also a co-host on a podcast called The Two Wealth Show with my good friend Elizabeth Mayora, aka Super E. Those of you that are local know about Super E. She is she's a guru in the short-term rental space. So she knows how to manage these properties. She knows how to flip them. She knows how to get them under construction and repair them. She knows how to find the people like on Airbnb and VRBO and things like that. And she is just a wealth of knowledge on the short-term game. And so she's our go-to person about that. So we have a good banter back and forth about what I do and what she does. And we bring guests on and stuff. So it's a pretty cool show. It's actually our second season. Our first season was named something different. It was the Super E&J podcast. So we stream this also via video, and we post that on the Bright Path Notes YouTube channel, and you can check out all those episodes there. They're in between 20 to 30 minutes long. And so we also, on the regular podcast directories, you can find them on any of these. I think we're on like 30 or 35 different podcast directories. The only ones I know really are the iTunes one and like Stitcher and Spotify. The only ones I didn't know about all these. Apparently they have like 30 or 40 of them. So anyways, if you want to watch the video, check it out on our YouTube channel, Bright Path Notes, or I just go to Apple Play or iTunes, and I listen to the episodes on those as well. Appreciate a subscription. All right. So today's agenda is we're going to go over the note basics, which we like to explain for those of you that are new to the call. Like Mia mentioned, she's a newbie. So this will be a great intro to kind of what notes are and kind of how it works, a rough introduction. I always like to give a mortgage industry update just because everything is revolving with this COVID-19 and things are changing, and you hear things and you hear other things and you're like, what do I believe? What I don't believe? I show you the data, the hardcore data that's going on. You can make your own decisions from it, but I show you what's factual, what's nice. So tonight is going to be another open mic night. We had a very good open mic night last month, and a lot of people wanted to have the opportunity again. So for those of you that has questions, like Tiffany already put a good question into me earlier today, so we're going to answer that. So be thinking of things that you want to know about the note business. It could be anything from a very short, general, small, introductory type of question to a very advanced question. If I can't answer it on the call, we'll certainly turn it over to offline, and we'll kind of have a deeper conversation, but it'll be fun. So this is recording right now, by the way, and we'll have the replay available tomorrow, more than likely, or the next day. So I don't see any questions on the board so far. So we will move right along. So one of the things that is coming up here is Note Expo. Note Expo is probably one of the biggest note events of the year, and it's really held live and in person in Dallas, Texas, or Fort Worth, Texas. And so this year, because of everything that's going on, they have decided to make it all virtual. And so you can save $100. Just email me, justin@brightpathnotes.com. And I'll send you the link to sign up for Note Expo if you're interested. It's a 2-day event. They always have excellent speakers that are professionals and that are the people that we look up to in the note business. They have hedge fund managers. They have Eddie Speed of Note School. He's definitely one of the hosts of Note Expo. And so it's just a great way to get more education on notes and find out what other things are going on in the note business. They always give a nice update on what they're doing on Capitol Hill with seller financing. And so that's going to be kind of fun. Jeff Watson usually leads that conversation. Jeff is an attorney in the Cleveland, Ohio area. I think that's where he is at. And he's definitely a wealth of knowledge. He's also the general counsel on the National RIA board as well. So anyways, that is November 6th and 7th. It's all virtual. And if you want to save $100, just email me and I will send you the link. Otherwise, if you're on our email list, tomorrow I have a MailChimp scheduled to send out that link as well. So you can get that either way. But love to see you be a part of that as well. All right, cool. Caught up over here. All right, so now we're going to get into the note basics. So we have imaginary house here, okay? We have to have a buyer and a seller because that's how a transaction is going to work. Okay, what happens is the seller owns the deed to the property, right? And they convey that deed to the buyer at the closing table, right? The buyer is more than likely going to need help financing the entire amount of the house. They typically don't see all cash sales for like a primary residence. So they're going to go to a bank, let's just call it Bank of America, and they are going to get a note in mortgage, or sometimes we call it a mortgage note, to have the remaining balance of what they owe to the seller at the closing table. So the bank is going to fund what they fund to the closing table, and the buyer is going to put down their down payment. All those monies are going to be funded to the seller at the closing, and that's when the seller conveys ownership over to the new buyer. Pretty simple, right? So keep in mind that the bank is securing their loan that they're giving to the buyer via a promissory note and mortgage. The mortgage secures that property and says, hey, if you default, Mr. and Mrs. Buyer, we have the right to collect on our what's due, and then we have that property as collateral. Okay, so remember, the bank owns the note, not the house, and the buyer now owns the house and they're on the deed. So that's just something that we just want to make sure that's clear. It's different than having a car, right? When you have a car, really the dealership owns it because they hold title to it until you pay it off, right? It's because it's an installment payment. All right, so now we got a homeowner. They're on the deed and they have a lien against the house. The bank owns the note, not the house. The homeowner owns the property, okay? So now this is where we come into note investing, and this is where the visual will kind of take effect. So you have this investor. That investor can be an LLC. It can be a retirement account. It can be someone that personally just buys it with cash. It can be a trust. Really, any entity or individual that has a lump sum of money that can buy the note, that's when this happens. So as you can see, the money exchanges hands to the bank. So the bank sells the note, and notice the deed and the property didn't really change hands. It's just the mortgage note changed hands. I'll just rewind that. I guess it doesn't rewind that way, silly. There we go. So the note and mortgage changes hands. My screen is not clicking as fast as I want to. There we go. Monthly payments now go to the investor. So remember, the buyer is paying the bank every month, just like clockwork. Let's say it's $1,000 payment. It's going to Bank of America, Bank of America. Then next month, now it's just going to shift to a different person, right? So the borrower, nothing changes for them other than the fact that their payment now goes to whatever this investor is, like we talked about, retirement account, LLC, individual, trust, so on and so forth. So now see the money comes, instead of going to the bank, it's going straight to the investor. So the investor is collecting the cash flow now from the property. So just remember that the bank owns the note, and that's what we're investing in. We're not investing in the property. All right, so any questions on that, please feel free to fill in the Q&A, and we can review that. So mortgage trends for 2020. We're almost done with 2020. We're halfway through October, right? So I get my data from Black Knight Financial Data. They are a company that focuses on the mortgages, the servicing of the mortgages, and the mortgages in general, like the Fannie, the Freddie Mac, Ginnie Mae, the VA loans, the big bank loans, and the portfolio loans and things like that. So they monitor all that because it's all registered through like MERS and things like that. So they collect all that data, and when they take that data, they kind of break it down, they analyze it in very specific ways so we can kind of see what have trends been before COVID-19 and what are trends now during COVID-19 and what will trends be, you know, after or post COVID-19, whenever that time frame is going to be. So the big headline, and sorry, I usually focus on one thing at a time. I didn't put the graphics together correctly, obviously. So their headline is, at the current rate of improvement, delinquencies will remain above pre-pandemic levels until 2022. And we'll get into that in a little bit. Loss mitigation and high levels of equity help mitigate foreclosure risk. If my internet is unstable, I'm sorry. I just got a message saying it was unstable. So I apologize about that. If you guys notice if I'm frozen or something, just type into the chat box and we'll get this figured out. I may have to turn off my camera to help with that. Interesting note, right? About the high levels of equity help mitigate foreclosure risk. And we're going to get into that in a different slide so you can see a chart, because I like charts, okay? Of the 6.1 million homeowners who have been in COVID-19 related forbearance plans, 41% or 2.4 million have since exited, with the vast majority of those borrowers currently performing. Of those who remain past due, 267,000 are in active loss mitigation with their lenders. So what is active loss mitigation? It basically means they're going through foreclosure or they're trying to figure out how to modify their loan, right? So record levels of equity continue to help mitigate foreclosure risk, with only 9% of homeowners in forbearance having less than 10% equity in their homes. That's an interesting fact there. So what they're saying is, of all the forbearances, 9% of those have less than 10% equity in their homes. That's a very interesting fact. I would have thought it would have been the reverse of that those mortgages would probably be underwater, but it's not. And what's helping it is this high level of equity that help keep the foreclosure risk out of it. So this is why you're going to see in these charts how, because of high levels of equity, people are able to refinance their loan or sell their home and get out of their mortgage payment. Okay. So even in forbearance, because of this hot real estate market that we're in, this is very interesting stuff. So that's why I wanted to point out those couple of things. All right, Jamal, I got your questions up there. We'll definitely get to those in the Q&A. I'm going to get through our mortgage update, and these are some good questions we have. So we're already piling up some good questions here. Keep them coming. Keep them coming. All right. This is my favorite slide because I love to watch this slide every month come in. So the national delinquency rate for first lien mortgages. This does not include every single mortgage in the world. This includes about 55 to 60 million mortgages. Okay. So they're saying about 6.88% of all mortgages that this data collects, which is the Fannie, the Freddie, the Ginnie Mae, the VA loans, the FHA loans, the big bank loans, the portfolio loans. Of all those loans right now, the delinquency rate, meaning anybody who is 30 plus days behind in making a payment, it's about 6.88% of all those mortgages. I believe last month it was 6.9%. So it's gone down a little bit, about 0.5% from previous. So if you look what history shows, where we probably should be around this time with the average, the green line is just the average from 2000 to 2005, which was a very, very good year just to show what normalcy is, right? So the normalcy around this time was 4.39% of delinquency. We're not that far off from it at 6.80. It's looking pretty good. So you can see it spiked up there about almost 8%, and then it's been coming back down, and now it's kind of tapered off slowly. And we're going to look at some more data for that. So this was another interesting slide too. So I'll try to explain this the best I can. So the delinquency rate following natural disasters, and then with this COVID-19 is going to be considered a natural disaster, right? So the difference in delinquency rate versus 1 month prior to the event. Okay. So if you notice, number of months since event is this bottom axis down here, and this other axis is just a percentage point. So obviously during COVID-19, which is the dark blue line, delinquencies obviously went up pretty quickly. So I believe starting in March, so we'll just say like April or May, somewhere around there is probably when this is. So if we're assuming March or at the end of February was our COVID-19 beginning period, we're probably looking at April to May timeframe when we kind of peaked on this. And then it slowly has tapered down, right? So the trend based on a 3-month average rate of improvement, so that means they looked at June, July, and August and showed a trend of what it looks like during those 3 months of working to get better. That's what this dashed line is. And so you can see it stretching out pretty slowly. Now it could jump down a lot, or it could, flatten out a little bit, but basically the average is going to show us more than likely what's going to happen. So if you know, it stretches out really far, and it looks like it's probably going to be March of 2022 when we're probably going to see this back down to what normal delinquency is. So what it tells me is that this is just going to be a very slow downhill roller coaster for a very, very, very long time that we're going to see for delinquencies for them to approve. So that means in the 2008 financial crisis, we had up until about 2011, 2010, where it got to the worst delinquency rate. And then when we started seeing all these foreclosures, we just had a surplus of foreclosures just coming down the pipeline, right? All at once. Now this is going to take that in a smaller amount, but stretch it out over a long period of time. So you're going to see more foreclosures. You're going to see more delinquent notes, but they're not going to be all at once. They're just going to be kind of dragged out over the course of 2 years, right? Anybody have any questions about that? I got more grasp, but I just want to pause for a second. Just go ahead and chime in. All right, so the cumulative share of mortgage payments received. This is an interesting data point as well, because it shows in April, May, June, July, August, September, it shows the day of the month when people are making their payment. Now, in a perfect world, we all wish things were due on the first and all the payments came in on the first, but that doesn't happen very much, does it? And for the most part, I actually do have a lot of loans in our portfolio that end up paying the 15th is the day of the month they're supposed to pay. So it's, it is what it is there. So you'll notice as we creep further up into a month, we obviously get more and more payments coming in. So it would appear that for September, we're seeing slight improvements. So that's that dark blue line that's kind of at the top. So obviously during September 22nd, 2020 is probably the last data point they have for this report. And so you can see it's definitely trending more upwards. And so the previous 4 months before this show that eventually, once it gets to the end of the month, we're having over 90% of mortgage payments coming in that they're coming in, which tells us, it's a positive sign. It's not like it's 60% of mortgage payment, or like if people are on Facebook spouting off these different numbers and stuff. This is what the factual data is. So it's showing that for the most part, we're getting all of our mortgage payments coming in. They may be behind a little bit and not paying on the first, but they're definitely getting in. And it looks like, more than 10% of them are getting in before the 30-day period. So this is another look at it in a bar graph for the mortgage payments received through the first 3 weeks of each month. This is good data too. So in April, you see, this is probably when people were able to get through March and April with their savings. And then in May, they started to see a problem. And then June, it kind of trickled down there. And then the government surplus helped us out. And then, people got some money. And so they were able to make more payments. That's why it jumped up. And then August, they use some of that money, and then things are getting back to normal. Things are opening up in September. That's why we're seeing closer to a 90% for the first 3 weeks. Now, the fourth week, obviously, we don't have that data. It's probably going to trend a little bit higher. And same thing with rental data, too. I don't have a rental data graph, but rental data was very similar to that, too. People are starting to make their rental payments. Some of you on this call may have a rental and be like, no, Justin, it's not happening like that. Well, I'm not in the rental game, so I don't have all that information. All right, so the current status of COVID-19 related. This slide can be very confusing. So if you become cross-eyed, don't worry. I get cross-eyed when I look at it too. But it's a neat slide to look at in a pie form. So the status, keep in mind, is as of September 22nd, 2020. So we're looking at, let's just look at the big part of this pie here, the active forbearance term extended. So 2.8 million mortgages, or 46%, they have extended their term of their forbearance. So we're talking about just the forbearances. That's all we're including in this pie. Within this pie, we're breaking down the forbearances within this pie, okay? So we got all these mortgages that extended. So basically, they went through 120 days and said, you know what? We need to take the rest of the year or the 12-month process for them to have a forbearance, right? So what's also a good sign is that 1.8 million, or 30% of the entire forbearance pie, has been removed, expired, because it has turned into a performing note. So they have started performing and they have continued to perform. That's a very good sign. That's 2 million mortgages. That's a lot. So the next little yellow slice down here is removed, expired, delinquent, active loss mitigation. So that's where the 267,000, or 4% of these forbearances currently are in active loss mitigation, to where they're not even making an effort, and they're going through the process of being foreclosed on and working with a lender, okay? So the smaller section of it, 54,000 that are just delinquent, they're probably not working with the lender yet, or they're just not working with the lender at all. So the paid off ones is interesting too, because that is what we were talking about at the beginning of the conversation about why real estate levels are so high, that people are able to refinance and they're able to sell their home to get out of this forbearance situation. So that's why we see some of these numbers taper off. So the 30% that are reperforming and the 6% there that are paid off, that 36% is really helping, turn down this forbearance. So the 6 million mortgages, turns into about 3.5, 4 million mortgages that are really in forbearance at the end of the day. So the numbers start to look a lot better. And so finally, the last thing is active forbearance, original term. That means they entered the forbearance late in the game, like maybe July or August, and that's where they're at today. So there's a ton of other charts and graph. If you download Black Knight Financial Data and go to their data reports, I believe it is, and you can look up the August release, and you can see all this information. So the September release probably is going to happen, I would say, probably next month. All right, I'm still getting internet unstable issues, so just chime in on the chat box if you guys have missed something, okay? Because I don't know if you're missing something from me. All right, this is another fun bar graph that looks very confusing. Let's see if we can wait. And I promise I'm almost done with charts, okay? Status of loans that have left COVID-19 related forbearance plans. Okay, remaining share all still in forbearance. All right, so you notice the different colors here. We got dark blue, light blue, green, and then the goldish color. Everything's within this bar, okay? And we got different percentages in there. The bottom part of this graph is probably self-explanatory, but I'll go ahead and tell you what it is. So the FHA are the FHA loans. The VA loans, the GSZ is like the Fannie Mae, the Freddie Mac, and the Ginnie Mae loans. The portfolio loans are like the big bank loans. The private securities are like jumbos. And then the total market is just showing you over here. So it looks like the paid off portion, you can tell it isn't as, you're not seeing that as much in the FHA, and you're not seeing it as much in the private securities. The performing seems to be the bigger chunk in all of these. And you'll notice that the delinquency, loss active MIT, and the delinquency not loss MIT is going to be in some of these other weaker borrower, I'll say, loans. So like the FHA loan, you would expect it to have weaker borrowers because they don't put down large down payments, and they have to pay PMI and things like that. The VA loans are a little bit stronger. The GSE loans are stronger. The portfolio loans looks like they take a hit, and the private securities as well. So that's some interesting data points there. So if you have any questions, just chime in. Otherwise, I will continue. Hopefully you're not yawning. So I think this is the second to the last chart, I promise. So I thought this was very interesting. So negative equity volumes and rates. So what this graph is showing us, that all these mortgages, if you look at the bottom, you'll see it's from 2004 all the way to 2020. It's showing you a data point at one time of the year, which happens to be, it looks like December of each of these years. And so you'll see the dark blue bars indicate the number of underwater mortgages. So you can see in the millions of how many are underwater. And that's because the financial crisis and the real estate market crashed. Makes total sense, right? So around 2009, 2010 is right about when the 2009, about when the crash started. In 2010, it hit the peak of it, and then it started to change direction, right, in a better way. And so if you look at where we came in 2019 in December, but now in June of 2020, it's not looking that bad, right? And it all stems from a really strong real estate market that's helping all of this not roll down the hill in a horrible way. So 970,000 mortgages are in negative equity, right? That's where this line is going. So that's a good sign. All right, this last graph just kind of recaps what's happened over the last year or so. So this data up here, you don't have to pay too close attention to it. It's just a bunch of fancy data here. But basically where we're at is the 6.88%. Sorry, I waved my finger over the mouse. So this month, at the end of August, we're at 6.88. At the end of July, it was 6.91. You can see in June and May it was at its worst. And then right before COVID happened in January, it looks like it was its lowest. And then February, it creeped up a little bit in March. And then it's pretty much almost doubled in April right there. So you can see all that information. You can see all these foreclosure starts, all this stuff. And then now it's not, because why is that? Because of a moratorium, right? That's prevented a lot of foreclosures. So there's probably a buildup of foreclosures that will happen. And we may see a few months in a row where we're going to see a big influx of foreclosures. I don't think it'll last that long. Like I said before, that trend that was showing in that one graph said it's all the way to March 2022. So I'll move forward with that graph. It's very busy. Sorry about that. But you can find all this stuff on Black Knight Financial Data. Okay. Open mic night. All right, here we go. Tiffany, I promised you I would do this, so I'm going to ask your question first. Go over subject 2 as it relates to notes, as well as how to go about the process of a subject 2 successfully. So a subject to, by definition, for those of you that may not know what that is where a lender has a borrower that is kind of underwater, right? Or they might not be underwater, but they might be really close to being underwater with their mortgage. So maybe they owe $114,000, and maybe the property is worth $115,000. So the person that wants to buy it from the borrower can take over the mortgage subject to. So that means they basically, the original borrower is still on the mortgage, and they are responsible for the excuse me, for the mortgage. The buyer can come in and actually take over the mortgage and sign some paperwork with the bank to say that I'm going to make the payments, but the borrower's on the hook for it, the original borrower. And so people will, fix and flippers and other people will do that so they can make a smaller payment on the property as they're fix and flipping it, so they don't, and improve it so they don't have to make the full payment to the bank. And so this is a good way for them to kind of slide in there and pay almost rent type numbers and still kind of make it through and make a bigger end. So as it relates to notes, so if you're on the lender side, basically you have the option if you want to do that or not. So some lenders may be like, yeah, that makes sense. I want the cash flow. Go ahead. We'll sign some paperwork. Let's do that. That's how it would work. So I haven't had a borrower need to do that. So I haven't been on the lender side of it before to answer that question. But being on the sales side of it, the person that's buying it, yeah, you can do that. So hopefully, Tiffany, that answers that question. Let me know if it didn't. Chime in the chat box if it didn't, or I can unmute you and we can kind of talk through that. All right, so cool. All right, so how much minimum you need to buy a note from a bank? Well, buying a note from a bank, a real bank, like a big bank, is pretty difficult. You have to navigate through a lot of departments. You have to find a department that understands what you're doing, like an asset manager, and want to work with them on either a one-off or a portfolio basis. A smaller bank, like a bank with a few branches, you'll have a better chance of working with them. We personally haven't been that successful in finding a lot of true bank loans. They typically want to sell off a large amount of loans, and they also have the opportunity more than likely to sell to Fannie Mae and Freddie Mac, who the GSEs, that's their job, is to gobble up all these loans. So from a true bank, it is challenging to go through, but people can do it, and they typically will be able to do it with non-performing a lot easier than performing. But just to give you kind of my 2 cents on it. So in general, when we buy loans, we buy them, probably giving you too much information, Allie. And we buy loans from like hedge funds or private sellers who create seller finance notes. And those notes are kind of our shadow inventory that aren't accounted for in all this stuff that we went over, all this data. And so we find the better deals that way, and we're able to work with hedge funds and build relationships that way as well to buy them. So we've bought notes and created notes as under $10,000, and we've bought them well over and created them over $100,000 before. So that's what we find, is that the best bang for the buck is spending anywhere from about $30,000 to $50,000 per loan, and that gets you a really solid yield, and it gets you a pretty decent collateral, and it gets you a good borrower. We find there are a lot of challenges once you get down to a lower unpaid balance loan, like, under $20,000. There's just a lot of challenges with it. The collateral usually isn't that attractive and maybe on vacant land and things like that. So hopefully that answers your question. So I would say in between 30 to 50,000 is going to get you a decent loan. It's probably going to be from like a hedge fund or a private seller as well. All right, let's go to another question here. Guys, keep the questions coming. I can definitely unmute you, and we can roll that way. All right. Can you use other people's money to buy a note, or is it possible to become a note broker? Yes and yes. So the other people's money is a leveraging technique, and that technique is called kind of like a hypothecation, or it's kind of like a yield override. What else do they call it? They got another fancy term for it. But let's call it hypothecation for short. So let's say I have an investor that wants to make a 5 or 6% return on their money, a yield. And so I say, okay, let me borrow $100,000, and I'll pay you as like a 5 or 6% interest rate, let's say, like a bank loan. And then I'll use your money to go out and buy loans with it. And obviously I'm going to try and get loans where my yield is going to be higher than 5 or 6%, like 7, 8, 9, maybe 10%. And so I'll have that yield override in between. So it's kind of like having a rental where you have a mortgage on it, and maybe your mortgage payment's $500, and maybe your rent payment's $1,500. And $500 of that $1,500 is like taxes, insurance, and property management. And then you owe $500 for your debt service, and you're left with $500. So that's your positive cash flow. So it would be very similar to that. So they call that kind of like a hypothecation. So yes, you can use other people's money, but you want to pledge those notes that you buy as the collateral, because they need some sort of security. They're not going to give you an unsecured loan, right, at that rate. They want security. So that's what you would do a collateral assignment for, and you would pledge those loans with their money. Sometimes I do that with partials. I'll sell partials so I can, have a loan that's already working and just pledge that for them so I can recoup some capital and go buy other loans as well. So that's a very good question. And then the second part of your question was become a note broker. So that's kind of how I started in the business as well. Or when I can't fund a deal myself, I'll find a buyer for it. So I have institutional buyers that I work with, and some of them might be banks, and some of them are hedge funds, and some are even private sellers as well. And so we've developed those relationships. So when I find a deal that I like and I can't buy myself with, our company money or a retirement account or our trust or whatnot, we go ahead and flip it over and market it for sale for someone that I know that will be interested in it. So that's how you're a note broker. So you're kind of the middle person or the wholesaler, to where the buyer and the seller, or the buyer and the seller on the other side, and you kind of the middleman putting the pieces together. Let me know, Allie, if I didn't answer that question all the way. All right, got some more stuff on the chat board here. When you say pledge these loans, which loans are you talking about? That's a good question. So let me see if I can draw this out here. So if I get a drink of water. Let's say I have a performing loan in my portfolio right now, and I am, I might be able to stop screen share. Let's go to the whiteboard. I think I have a whiteboard on here. Let's get fancy, y'all. Right. I want to share the whiteboard. Bear with me here. I'm not the expert on the whiteboard. Let's say I have a loan that has UPB, stands for unpaid principal balance. Okay. Let's say it has a balance of $50,000, and it's let's say it has an interest rate of 6%. And it has a monthly payment, so we'll say P&I, principal and interest, of $500, okay? And it has the term left on it, let's just say is 60 months, 5 years. So this note right here that I have up here, I'm going to pledge it to borrow some money. So let's see if I can do another, lost my mouse, another text box here. Let's say I have an investor that wants to give me, I'm sorry, I can't spell, gives me, let's just say $25,000, okay? And they want say they want a 4% return, and I can make a payment to them for, I don't know, let's just say it ends up being $200 a month, and it's for, let's just say it's for 36 months. All right. So as you can see, this investor needs collateral, right? So it's just like if you were lending on a house, obviously the house is your collateral. We can also use performing loans as collateral. So I would say, hey, Mr. Investor, I'll take that $25,000. I like that rate. I like the P&I put rate twice. I must be falling asleep here. And so obviously I'm getting a $500 payment in here. I'm going to pay you $200. I'm going to keep the $300 as positive cash flow, right? I'm going to do this for 3 years. So now I can take that $25,000 and I can do what I want with it because I have this loan over here that I pledged as collateral. So hopefully that made sense. I should use the whiteboard more often. I feel like that helps out. Lost a couple windows here. Sorry about that. All right, so that makes sense. That's what you pledged. So sometimes people will just do a hypothecation that way, or they might say, let's change colors here. Sorry, guys. I'm getting used to clear. Let's change. Can I change the color of the? All right. So let's say now that I'm going to do a partial. So this is another way that you can kind of pledge money. So let's say that same investor, I said, you know what? I'm just going to sell you a partial of this loan. So I'm going to say, I'm going to sell you this loan for $25,000. Okay. And you're going to get, let's just make it all numbers make sense. So the rate's going to be 6%. All right. And he's going to get a $500 payment. But let's say they're only going to buy 24 months. Okay. I didn't really do the partial math. Let's just pretend like it's correct. And so then after 20, so basically they give me $25,000. I give them the front part of this note. So I sell them 24 payments up front. So they're going to collect this $500 payment 24 times. And then on the 25th month, it's going to kick back over to me. And then I start collecting on it. So that means I'm not really responsible for the note, which is nice. I get some of my money back out of it today and I can go reinvest it somewhere else. And then this investor gets the cash flow up front. They're also partnered with me basically because I'm on the back end of this going, hey, it's going to be my turn soon. So that's what's cool about that as well. So the partials are a little more difficult paperwork, and you want to make sure that your partial investor, like when we work with partial investors, we make sure that these loans are very strong performing loans. The last thing we want is for this loan to go sideways and for them to have to deal with these challenges. But basically that's kind of how it works. The hypothecation is like two different ways. You can borrow money, then pledge a loan, and then you can do a partial. Sorry, that was a very long-winded answer, Tiffany, but hopefully that works for you. All right. Hey, Luis, how's it going, man? Do you see an issue if buying a partial from a note investor's self-directed IRA? No, I don't. A self-directed IRA is treated just like an entity. As long as the documentation and how they purchased it or created it was done properly, there shouldn't be any issue at all buying it from self-directed IRA. I prefer to sell partials out of my self-directed IRA personally, because then I don't have to worry about taking taxes out in the future because all of our accounts are Roth accounts, like Roth IRAs. That's a good question. Let me know if you have a follow-up to that. Cool. All right. All right. So do you think it's a good time to buy a note now, given the current economic climate? Does note investing work well in all economic cycles? And how did notes investing perform in 2008 financial crisis? That's a really good question. So we'll kind of break this down in a couple of different ways. So do I think it's a good time to buy notes? Absolutely. Absolutely. It's a good time to buy notes. Not all notes are diving and taking every problems. We hardly have anybody in our sphere that has seen a major hit to their portfolio. There's going to be people that pay late. There's going to be people that ask for forbearance. But for the most part, the working class is getting more help from from the government than the middle class and the upper class, right? So they are making their payments, and their payments are smaller than rent anyways. So that's not the challenge. The challenge is more the middle class and the upper class level type of homes. So probably homes 150,000 and higher. You're probably going to see more challenges with those, and the percentages of those homes. The percentage of the forbearances are probably in those higher valued homes as well. That you're going to see. So I don't see a problem with buying right now, because we're buying right now, and a lot of investors are buying right now that we work with. So note investing absolutely works well in any economic cycle. And so depending on where we're at, like right now, we're in a very high appreciating market for real estate. So notes are getting paid down, and there's a lot of tappable equity that borrowers have gotten built into their loans. And so as a lender, it's a really good situation for performing loans. Now, when this stuff starts to slide a little bit, and we'll have more delinquencies and more forbearances and people not able to continue paying, then we're going to see more non-performing loans. And that probably be next year, maybe around this time, or maybe in the spring, that we'll start seeing some non-performing loans. And that'll be opportunities for us to switch our game a little bit and focus a little bit more on non-performing, go after those loans, see if we can get them remodified or get them reworking again, get the borrowers paying, and those will be very profitable for us as well. So any economic cycle, we find that notes always has a way to make money in it. Last part of your question here. How did note investing perform in 2008 crisis? Well, I think nothing performed very well in that crisis. That was a financial crisis and a real estate crash. So there weren't many people that came out unscathed during that time, even note investing included, because things just dropped in value too much and people were over leveraged. If you remember, it got to that point because you could borrow way more money than you should be able to. And just being over leveraged was just the worst thing that could happen during that time. So the people that were appropriately leveraged, they weren't scathed very much. But people that were over leveraged were definitely hurt very badly. And there's a lot of people that are my mentors that lived through it and told me stories. And it wasn't pretty because of being over leveraged has a big part of it, right? But if they played the long game, they got out of it, around 16, 17, 18, 19, they probably recouped their real estate equity back and were able to be just fine. So hopefully that answers your question. Which is more important when acquiring notes, capital or good credit? That's a good question. Let's see, how can I answer this? Which is more important, when acquiring notes, what's more important, capital or good credit? So I'm assuming you're talking about the borrower and not not us as the investor going after it. So we'll assume that. And so the borrower, when you're creating a loan, this is how I kind of break it down. When you're creating a loan from scratch, when you have a property and you want to sell it on seller financing, let's just make this scenario, you definitely look at the borrower's credit, you look at their financials, and you figure out, do they have the ability to repay this debt back to you? When we're buying a loan that's already been created and already paying, we don't really care about credit that much, especially when we're buying it from a professional seller like our company or like hedge funds. When we're dealing with a private seller, we're probably going to look at credit a little bit because they have probably not set up this loan the proper way from the beginning. So hopefully that answers your question. But there is a time to check credit, but it's typically not going to be when you're buying a loan that's already been created. So the capital to that question, are you referring to like the down payment? Okay, thank you for answering that. Sorry for the delay. So there's a lot of things about acquiring a note. For those of you on the call that haven't bought a lot of notes before, there's basically like 6 factors to a note that give its value. There's, the collateral, there's the borrower, there's the down payment, there's the interest rate, there's the terms on the paperwork, and there's a security agreement that's written on. Is it on a napkin? Is it a land contract? Is it a contract for deed? Is it deed of trust? Is it a mortgage? So on and so forth. That all those values, and they'll have different values, A, B, C, D, they'll all average out to something. And that average tells you what the risk is. We focus more on pay history. other people focus more on collateral to make sure they have a lot of protection. We find that you'll be looking at deals way too long before you pull the trigger. So we have found focusing on pay history is the most important factor in a performing loan. In a non-performing loan, it's probably the collateral is the most important factor, right? So that's kind of how we break things down. So we strongly vet the borrower's pay history, and that tells us a story of exactly what is going on with them, right? Hopefully that answers that question. Another long-winded one, sorry. All right, are you seeing the yield for notes that you are acquiring being less than it is been prior to COVID? If so, is it drastically less than before COVID? I'm not seeing a yield change at all with the notes that we're shopping with. When we work with private sellers, they're typically a lower interest rate. And so we acquire them at a price that gives us a stronger yield. And most hedge funds that are creating loans, they are already creating them at a higher interest rate for the lower unpaid balance loans, like let's just say under 60,000. So we're not seeing any changes in that because loans have already been created for a few years before COVID-19. So, but new loans that are being created, you're going to see like the $30,000 loans that are out there. You're probably going to see them at like 8, 9, 10% interest rates pretty commonly now. And that's how it was pre-COVID-19. So we're not really seeing any sort of difference in yield right now. Now, interest rates overall, are going up and they're going down a little bit. So that changes your overall yield just slightly as it goes to time value of money. But you have to remember, you're getting all this interest up front and amortization. So it kind of balances out pretty well. So hopefully that answers your question. Cool. All right. Thanks, Tiffany, for chiming in. Does anybody have a note that they're working on or getting ready to buy that we can put on the whiteboard? We can walk through this together. I'm not sure if I shared a loan I just created. I actually did a land note recently. Just erase some of these boxes here. All right, so I had a vacant land lot in Florida. And so I found an investor, and I did this. My friend Jaron Barnes, he's a RE tipster with Seth Williams, and they have their own podcast. I was on one of their episodes, and so they helped me understand how to market these vacant land for people to buy. So I went on Facebook Marketplace, and I did this beautiful write-up on Facebook Marketplace. I put the GPS coordinates in there. I put all this stuff in there. And I had this note in one of our retirement accounts for like a good couple of years. And I put a sign in the yard for this vacant land note. And this neighborhood mostly had a lot of vacant land in it. I didn't have hardly any luck. Like when I first put the sign in the yard, I got some phone calls and stuff, but nobody wanted to bite on it, right? But when I put it on Facebook Marketplace, man, I got like a ton of buyers interested in it. And all I did was put, I want $1,000 down. I'll do seller financing. So I sold this thing for about $7,500, I think, this lot. And it's tough to say what these things are worth with land. This is the first time I kind of created a note on land. So I sold this thing for $7,500. I asked for a down payment of $1,000. And I didn't tell them what the interest rate was because I wasn't sure who I was working with. So this person happened to be an LLC, and I think there was some sort of trust account. They were looking just to gobble up a bunch of land, just hold it in their retirement account, and eventually just turn into a profit many years down the road. So I said I wanted my terms were 48 months. I didn't want this land back. I wanted this person to be able to pay. So I didn't want to get too crazy with it, but I did put an interest rate in there of 11%. I think the P&I came out to 167 and some change. someone has a calculator, they can run that for me. But it worked out pretty nice. So I learned that Facebook Marketplace is a really strong way to advertise for properties and for obviously vacant land. And what I did was I found that my friend Jaron told me you need to find Facebook groups within that area that you're at. So this happened to be, I think, in somewhere like by Fort Myers. And so I got on some Facebook groups down there and just started advertising this. And then before you know it, people were just like, yeah, I'll do owner financing. Cause they think, oh yeah, $1,000 down. That's great. $167 payment a month. I mean, that's easy to make, right? So it was easier to sell it that way than say, hey, I want $7,500 for it. Because I had a lot of people say, I'll give you $3,000 or $4,000 for it. I'm thinking like, oh man, this was really a brilliant decision a few years ago to buy this thing. But anyways, that's kind of what I did. So I ended up doing a note and mortgage on it instead of a land contract, because quite honestly, I was just tired of getting the tax notices in the mail for all that stuff. So now this borrower is going to deal with all that. And then I didn't want to be responsible for the property or the lot either, because I think there was some people that were running some four-wheelers by it and stuff. And if they get hurt, then it's, they could sue my retirement account, so to speak. So anyway, I did that. And so that was a pretty nice way to start getting some more cash flow in one of our retirement accounts. Question popped up. Okay, what are you looking during the due diligence that makes you decide? And by the way, hi, Julian. By the way, that makes a difference when you decide, is a note a good note to buy? So back to what I said before about the 6 values, what's most important to me is pay history. So what I like to do is I look at a note, and I'll typically look at a tape of assets, and of that tape, I'll kind of filter it down by maybe states that I prefer not to go in. I may filter it down by if they're paying an escrow or not. I just like loans that have escrows built into them. I'll filter it down by, I said state, basically maybe the size of the payment. Maybe I don't want to be under $100 or under $200. Maybe I don't want to be above 500. I mean, I kind of weigh all this stuff when I'm looking at a loan. And after that, then I kind of look at, okay, what's the pay history situation for it? So I'll look at it and be like, okay, the pay history is strong, or hey, the pay history is kind of weak, or they skip a payment, or they're late, or what have you. And then after that, I'll be able to focus on the collateral. Because if I look at the collateral for all these, to me, it just takes too long. So it's faster for me to break down a tape by going through those first couple of steps, and then I can really filter it down tightly. And within that, we've ended up finding some good deals. So what really is a good deal on a note is something that has good collateral, meaning it shows pride of ownership, and it's worth, more than obviously what you're paying for. Now, what can that number be? It could be 50%. It could be 20%. It could be, whatever you're comfortable with. And you look at it and be like, that's a nice piece of property. I like that. Borrower putting down a large down payment, that's obviously a very, very good sign. And a long pay history, like 2+ years, is a good sign of a strong pay history. So all those factors weigh into a good note. What makes it a bad note is if I see a lot of problems with the pay history and a low down payment, and if I see the collateral is just like, it's just not worth it. So that's what we like to see about notes: strong pay history, decent down payment, and good collateral, and that sets you up for success. So hopefully that answers your question, Julian. Cool. Does anybody want me to unmute them? Oh, all right, Luis, got another question. Cool, you got it, Julian. During due diligence, do you consider the population size of the market where the property is located? A lot of people do. It's funny because we've sold notes in areas where there's like 500 people. We've bought notes in areas where there's just a few thousand people. I live in a town where there's just a couple thousand people. I like rural areas and small towns better than I do bigger cities. I find that the borrowers are a little bit better. excluding you, Tom. You got a weird situation going on, but I like them. So I don't get shied away from the population size. Like everyone probably prefers like, states like Texas, where they're fast foreclosure states, and they want a deed of trust, and they want a population of 50,000. I mean, it makes it easy to turn over the property when you have a large populated area. But I tell you what, in a town that I live in, LaPel, I mean, property turns over like within 24 hours. It's just a hot market in general everywhere. And most small towns are like that. When you're in the town itself, when you're on the outskirts of the town, it's a little bit different. Those are probably long timers for mortgages, making payments. They pay on this long time. The ones that live in town aren't as long payers. So hopefully that answers your question. But a lot of people do filter by large population. And so then again, you're competing with a lot of other people if you happen to be doing in a bid situation for a fund or on a tape. So we definitely, we're not going to go the full 2 hours tonight, just so you guys know. I'm still going to answer your questions and stuff, but we are getting towards the end of, there's no more presentation left. So I'm definitely here to answer more questions or do more whiteboarding for you guys. I think we got it from the vacant land lot here. Let's see. So sometimes we find loans through banks. A majority of the time we're finding loans either through hedge fund, someone else we know that's selling a tape, which could be from a bank, from a loan servicer, or from private sellers. So we will market to basically send out a mailing campaign, like a direct mail, and we'll say, hey, Mr. and Mrs. Lender, we noticed you lent money on property XYZ in Spokane, Washington. Would you be interested in selling your note, or did you know you could sell it? And so we'll find those opportunities like that. We haven't done direct mail in a while, but locally here, we're pretty well known as the main note buyer in the area. So we get those opportunities that come to us to where we can buy those loans. But that's mostly where you're going to find good inventory, is from hedge funds and from private sellers. If you go to a bank or try to get into a bank, you're pretty lucky to make it that far. But typically we don't see a lot of those loans. And if we do, it's being advertised to a lot of different brokers and stuff. So you have to be careful of daisy chains and stuff like that. Good question, Luis. So do you think the due diligence process is any different when acquiring a partial versus a whole note? I don't. Yes and no. I would say it's a little bit different, because if you're buying a partial, you're buying the front end payments, right? And depending, like you put a post on Facebook, our Facebook group a few days ago, and I tried to answer that. It was a good question about what you would pay for one. And it always depends on who you're buying it from. If you're buying it from what I call a mom and pop seller, you can probably get more opportunities to get better yield for yourself. If you're buying it from a private seller, they know the math and they know the financial numbers to where you're not going to get those higher yields from them. So I wouldn't expect that. But what you do get is you get the confidence of a partner on the back end that's going to be able to help you out, because they have a vested interest to make sure that that loan goes to, not necessarily for maturity, but to make it through the long run, right? Because that's when they start making their money back, is at the very end. So I look at a partial, either selling it or buying it, making sure that pay history is strong and the borrower is strong. Because the last thing you want is have two different companies in the same deal and stuff goes sideways, right? Because that just makes it harder, and you're helping them out. Like, so sometimes, we or other people that I know, they'll buy back the partial from people if something happens, or they'll start making payments for an investor as well. So that's a pretty common, it's like the right thing to do, I'll call it. And then some people obviously would, you know, could give two flips about it, and they will just be like, hey, you're on your own, right? All right, I forgot I had the screen share on there. Cool. Yeah, partials are really neat. They're really good to have in your retirement account. Like I said, if we do sell partials, we're trying to sell them in our retirement account just so that we can recoup that capital and we don't have to pay the taxes on the gain or anything. Because our accounts are going to be IRA type accounts, Roth accounts. Zoom's got a new screen here, so I'm trying to figure out. I got a participants window and a chat window on a different monitor. If you guys are looking at me like, why is he doing that? Why is he looking at weird places? I'm a weird guy, right? All right. Does anybody have any other questions or comments? You can raise your hand. There's a feature to raise your hand on the board. There's also an ability to do Q&A and chat. And we can unmute you as well if you care to talk at all. It's coming up on about an hour and 20 minutes into the presentation. So you guys can stay on the call, but I'm going to stop the recording on it. I like to keep the recording as short as I can. And those of you that want to stay on, I'm definitely going to be on to help answer some more questions, or we can whiteboard some stuff. And for those of you that are watching the recording, we will catch you next time. Don't forget that, let me share the screen here for our next meetup. Is going to be November 11th from 6 to 8 p.m. It's more than likely going to be on Zoom again, just Zoom only, virtual only. So don't forget to follow us on BrightPath Notes, Facebook, on Twitter, BrightPath Notes, and Instagram, BrightPath Notes. You can reach me, Justin Bogard, at brightpathnotes.com. It's Justin at brightpathnotes.com. And don't forget, we have a Facebook group. We mentioned at the beginning of the call. It's called Be the Bank Real Estate Note Investing. It has this picture in the background of what we show on our meetup. And it's a Facebook group, so you can be a part of it. Just ask to be a member, and we'll get you in. And that's where we post these replays and stuff. And if people have questions, like the people that have asked questions today, they're the same people that have been asking questions on Facebook, which is nice, so we can help you guys out even outside of this meetup as well. So I'm Justin Bogart with BrightPath Notes. The rest of you can stay on, and we will end the recording.